But from your personal and professional level, you need to say, should I associate myself with this business? Because it's questioning my ethics.
You know, on that point, is that what we don't realize on the public interest role, and I only realized this about 2 years ago, is that how do you affect lives? If you look at the Steinhoff cases, we haven't yet gone into the second phase of Steinhoff, where the suicides are going to happen. We haven't gone into that. So think of all the accountants in the Steinhoff, because if you look at all the corporate failures over time, Enron and whatever else it may be, remember, people lost their savings, they lost their livelihoods, etc. Not everybody can recover. Like, I can recover from Steinhoff last year because my pension fund was in it. I'm 34 years old. So whatever I put in my fund was gone. But think of some people who are lower income earners, some people who are retirement, who actually relied on this thing. There's going to be suicides within the decision. So that's what they also, that is why when you're saying the behavioral competence of accountants become more important is, can you actually face your community? Can you actually face the individuals, knowing that now there's going to be suicides, there's going to be medical issues, and things are going to collapse? How do you actually sleep at night, knowing these things? And that's what we're talking about in terms of the code of ethics, in terms of integrity. If you actually do things right the first time around, and you actually just are steadfast in your courage and your conviction, it's not about reporting or whistleblowing. It's about separating the two issues. The one is I reported the information. The second thing is I need to disassociate from the information, or I need to change the behavior of the client. Because sometimes people don't set out to be unethical. They just assume that because everybody is doing it, we should do it this way here. So it becomes the norm of it. And that is why the code of ethics is so important for the professional accountant. The information has to be neutral. It can't be what we want it to be or what we like it to be. It has to be based on the economics of the decision. Economics does not lie. How do you know economics does not lie? We live in a free world. Would you all agree with me? You all have rights, agreed? You all have passports, you can vote, correct? But then why do we have slavery in the world? Slavery was abolished in the 18th century. So if you had to actually classify people in financial statements, if you're allowed to, if you look at India or you look at China or you look at miners, they all are actually economic slaves, which means that they should actually be recognized as an asset and depreciated, like how you depreciate your property, plant, and equipment. It's just that people won't actually recognize it like that there because they say slavery is abolished. Making sense? So we don't have slaves. But if you look at it, what is the term, what is an economic slave? An economic slave means that regardless of the outcome of your life, you will be born into this life and you will die in the same way. You have no control over your income, your livelihood, where you live, how you live, or what you can do. Yet you are free to citizen walking around the world with a passport and a right to vote. So same thing about financial statements is that they classify the economics principles-based standard. A computer cannot classify economics. You need to understand that. Economics is something where you actually look around you and you say, what is the reality of the situation and what is it that I'm going to report? Because everything in accounting starts with an estimate. You must understand that. We create the entire environment. We're like wizards because everything around us is not real. So we can pick any number we like. We can pick any measurement tool that we like. We can value things any way we like it. And we can create realities that we like. So that is the problem with accounting. If you don't stick to economics of the accounting, you could paint realities and you could paint pictures that actually don't reflect anything. And the problem these days is, Prof is speaking about it, is professional competence and due care. We're all not unethical. People have just gotten into a complacency of actually not thinking about what is the impact. Because we're so used to just getting the value of the system anymore, we don't think about what we're writing.
Then that links into objectivity. How many of your clients in their financial statements do you have an item under property, plant, and equipment which either has a 1 rand value or a 0 value?
Please don't tell me you do. No. Just say no.
Because if you have an asset which is fully depreciated and the business is still using it to generate income, then you are saying the business is generating money from nothing. And therefore, you are violating the standard in terms of fair representation of the financial position of the company.
You know, on that point there is that, you know, everybody talks about the revaluation method, revaluation, and at varsities, we go like psychotic, teaching it for 5 to 6 years. I say 5 to 6 years because it takes accountants 3 years to complete, 6 years to complete a 3-year degree. We all know that, okay? Why is that? Is because if you actually realize it, that we don't really need revaluation accounting, we don't really need fair value accounting in most instances, because cost accounting actually tells you what? I told you, you made the estimate, and what happens when the estimate changes? You change the estimate. So if the building is still standing and it's looking good and it's continuing, or the property, the equipment is looking good, you have the vehicle, should you not have changed the estimate? It doesn't require anything, it just tells you, calculate a new useful life and continue with it. But what do most people do? When they reach year 19 out of year 920, they were like, oh crap, I'm in a problem. I didn't do anything. Should I leave it as 1 rand? I don't know who invented the 1 rand thing. Maybe it was before my time. But that's actually a violation of accrual accounting. Accrual accounting tells you, so long as there is a useful life, you continue to change the useful life. It doesn't cost the business anything, because who decided on the useful life? Management, and you got a consultant in, you decided that the useful life was 5. So why can't you go back to however you got to the useful life and ask the person, what is the new useful life, and put it in? But most people actually don't get to that there. They want to change to the revaluation method and complicate lives. And they want to know then why clients are not understanding why the income statement is the way it is. Then we have confusing income statements which have unrealized gains that are supposed to not be there for an SME, because we confused it. And your client is then saying that the profit that I see in the income statement has no correlation to the bank balance. But then you never told your client what is the objective of the income statement versus what is the objective of the cash flow statement, and which statements you present to whom and for what purposes. We never went back to that there. Because the most important statement you would be discussing with your client obviously is more important in terms of cash flows, working capitals, etc. When does the income statement become important? When you actually have investors who want to come into the business, who want to see future potential in the business. The banks are more concerned about the financial position. Are you going to be able to pay the risk of lending? And every time you lie, you don't understand, the bank actually is very clever. The bank knows you lie with your clients. And they actually don't want to get in trouble with their Basel requirements of lending, National Credit Acts, Consumer Protection Acts, so they make it your problem. So what do? The more you lie, the higher the interest they charge your client. That's all they do, because they're in the business of interest and interest making anyway. So they want to lend you the money regardless of whether you can afford it or not. They just can't because of laws. So what happens is, when you manipulate, you're actually creating an unsustainable environment for your client. It's going to take 2 years or 3 years, and what's going to happen? The client is going to break. And that's where business rescue kicks in, but it's too late for business rescue. And then you want to go rescue the client after we've done this.
And I think based on that, what Yaeesh said, if you look at what he said about if you go to that you need to reassess your assets and liabilities at the end of each year, that is incorporated in all the standards.
Exactly.
If you go to PPE, your IAS 16, paragraph 46, you'll see that they say you must review the estimated useful life of your assets at the end of each reporting period. Similarly, if you go to the standard on impairments, it's also said that you must, at the end of each reporting period, assess whether the carrying amount of the asset still fairly reflects the economic value embedded in that asset. So it is all there. How many of you do an impairment test every year? If I've got the time, isn't it? And if I do it, will the client pay for it? So are we competent in what we're doing? Probably not. And that is what the standard says. And the same thing about changing your useful lives, etc. It links then on to what the next one is about confidentiality. Let me give you an example. If your client won a 6-year tender with government, say to construct infrastructure in Namibia, do you recognize that tender as an asset or not? Essie says no. Why not, Essie?
No, I say we don't.
You don't. Now let me go back to you. You all know the accounting framework, the conceptual framework. What's the criteria to recognize something as an asset? Isn't it? It's a resource. So is a tender a resource for the business? Yes. You're going to generate future income. Okay? Are there future economic benefits associated with it? Yes, if you do the work, you'll get paid. Hmm? Hmm? But then you must actually make projections. That's where your professional judgment comes in. Okay. So let's take it away from the government. You've got to file a 6-year contract with a large corporate which is successful globally. Okay? The other thing is also, do you agree that it results from a past event? Isn't it? You signed the contract. Isn't it? And in terms of that, whether you only got the tender, it must be recognized as an asset. By us not including it, we're understating the financial position of the company. I had something like that. A client came to me, they won a tender in South Africa for, it was about 30 million over a 3-year period. But he needed money to start the project. He didn't have it. His accountant went, did some stuff with the bank, and he'll give surety, etc. They declined it. I told him, I'll get you the money, don't worry. Yes.
If you then delivered your asset for the tender, what do you credit?
IAS 36, contingent. A contingent liability. Because, and that is where your judgment comes in, because or you can recognize it as a provision. And a provision says, depending on your professional judgment, is there a 50 to 100% chance that you will actually realize the benefit? If it's yes, then it's an asset. If no, then you include it as a note, as a contingent liability. We don't do it. And then I went, and all I did was, I told him, I redrafted the financial statements, and I said, under the assets, I said a tender. The bank manager called him in, I went with him. It was another professional accountant working for the bank for a number of years. I said, you do have a qualification? He said, yes, I'm a CA. I said, I'm so happy for you. I said, here's the accounting framework, here's the definition of an asset. I know what you do the tick box. There's 4 criteria, let us tick, 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 tick. And he saw he ticked all the boxes. I said, he's an asset, and that's why I recognize it. They gave him the money. 3 weeks later, he delivered some of the work, the government paid him. The banker phoned the client and says, I see you got money in. Don't you want us to invest it on your behalf? So I told the client, tell the banker, I'm actually going to another bank. And that is just because you're now applying economics, the economic phenomenon of the transaction.
Just on that point, on the conceptual framework, it's so important because, as you will see in the file, we have the new revenue standard that is being introduced. And I went to an international IFRS update, and the people in some jurisdictions were telling the IASB that, you know what, the way you actually prescribing this criteria will not be able to ever recognize revenue at all because the criteria is so stringent that you can't actually recognize revenue. And they said that actually that if you have been applying the conceptual framework all along properly, this new revenue standard wouldn't have been a problem. And what was the issue? The issue was in countries like where you have a large migrant force, like the UAE, etc. You could buy a house, you could buy a car, you could do everything in the economy, and tomorrow you could disappear. So think about like companies in that economy, how are they going to actually recognize the performance obligation? Because you could disappear and they can't actually attach anything to it. If you actually went to the conceptual framework, when you talked about the definition of an income, you already would have known at that point there, it was risky to actually lend money. So you already should have alerted your client that in this country, there's no National Credit Act, there's no Consumer Protection Act, there's no act actually enforcing the recovery of debt. So you actually should have actually looked at your working capital different. So why are you more concerned about the recognizing of the revenue when your service to your client is supposed to be, should you actually be selling to credit in such economies? And it came back to the conceptual framework. So the value and the advice for those accountants weren't actually how much revenue I should recognize. It was the flip side. And that's what I said. Shouldn't you actually be worried about your debtors collection policies and whether you should actually be lending in such an environment where you can't actually attach or recover?
Okay. So the next thing is the procedures that you do when you have your engagements. Now see, the first part of the procedure basically says that before you even accept an engagement, you must fully understand the nature of the business. You must understand the regulations which governs that particular business. You must understand the industry in which they are. You should also understand the business model that they use and governance that they use within that particular business.
I think Prof, you want to elaborate on business model, it's always good to refresh it.
Yeah. I think if you look at how many of you people, when you draft your financial statements, align the financial statements with the business model? The silence say no one does.
I think we want you to unpack the term for us.
Because business model implies that the processes in which the business conduct itself to make money and achieves its objectives. And that is why you'll see that financial statements is all about whether the business is still relevant in its sector, and secondly is, are they using models which ensure that they are competitive within the sector? Now the financial statement is supposed to tell you that. And I can tell you I reviewed listed and unlisted companies' financial statements. When you look at their financial statements and you look at the integrated report, you'll think you're looking at two different companies. Because the integrated report tells you about your business model, the financial statements tells you about nothing.
And if you look at it, the financial statements has to be written in terms of the business model because it's part of the integrated report. So so it comes down again to conceptual framework, conceptual understanding of how you created the set of financial statements. And if they're not talking to each other means that you actually didn't create sustainable and relevant accounting policies.
The second part that you need to do is, what are the objectives of an engagement? Why are you doing an engagement? Which means, why are you compiling financial statements? Why do you do audits? Why do you do what you are doing for your clients? If you don't know that, then you're operating in a vacuum. So you must know that. The third one is engagement procedures. How many of you people do audit work when you do a compilation? Should you do it or should you not do it? It depends. It depends on whether you can rely on the accounting system. If you can't rely on it, then you must do an audit. If the system is working and everything, then you can say, now I just need to focus on areas where I think are potential risks. So you need to do audit procedures. And lastly is about expressing opinions. And we'll come to about expressing opinions later. And that is what it says. When you're doing a compilation engagement, and that is in the standard ISRS 4410, it states specifically that when you do a compilation, you must evaluate the risk associated with the accounting system that is being used. And that is not only the accounting package, it's also in terms of the people who's actually processing the transactions. Do you agree that if I capture data and I do it negligently, can you rely on the information that come out of the system? No, you can't. Garbage in, garbage out. And that is why you need to look at the entire accounting system in terms of whether you will get reliable information on which you can base your compilation. If the risk is high, then you must do both substantive as well as verification procedures. But also when you do those procedures, you need to document it.
I think documentation is key.
Documentation is key because if you're going to stand up in court and they ask you, why is this figure as it is? And then you say, I did it about 9 months ago. I can't remember. The first thing the judge will tell you in that case, we got a nice cell for you. No blankets, the thinnest of mattresses, and you'll always be cold. Because there's no evidence based on what you are saying. And that is what that says. If you go to your review engagements,
To 400.
which is ISRE 2400, in that case you must do analytical procedures. Now a lot of people will say analytical procedures are ratio analysis. If they do that, if they tell you that, then do what penguins do. Smile and wave, because they know nothing what they're talking about. Okay. Because analytical procedures use ratio analysis differently. And I'll give you an example. If over 3 years, the company's current ratio was improving and it has always been above 2, is that good or bad? It's good from a business perspective. From analytical procedures, there's a possible risk. Why did your current ratio increase? Did you overstate your inventory? Did you inflate your debtors? Did you understate your liabilities? And that is what analytical procedures are. It's to identify the causes why there are changes in the ratios over a number of periods.
In fact, on listed companies and in banks and that's what analysts basically do, is that because they can't rely on the information presented by the accountant for larger financial statements, they actually have ways and statistical tools to unravel the actual level of manipulation on financial statements. And that actually determines the risk and the premium associated with the lending, etc. So while people don't realize this, over time, financial statements, you can actually be exposed within, I think it's 3 years, right?
Yes.
Within 3 years, you can actually expose the business to levels of manipulation. Because for the first cycle, you can manipulate. From the second cycle, you can continue to manipulate. But by the third cycle, people can actually predict your trends of manipulation, and they can actually see where the lies are by reading the financials and redoing the tests. And that's where the reviews, engagements, and those analytical procedures will pick up some of those risks.
And then the third one is an audit. An audit is primarily assessing materiality and also focusing on risk within the business and the financial information. And in that case, you can see for all three, depending on the level of risk, you do the same audit procedures.
Also depending on the level of public interest. I think it comes back to public interest. Remember that on this spectrum here is that there's a high public interest. So the public stands to lose the most.